U.S. government debt downgrade. Yet another rating agency downgrades the U.S. government's credit rating. Moody's just joined Fitch in recently downgrading our country's credit rating to AA. What does this mean for a nation already grappling with staggering debt? In this video, we'll examine how national debt, interest rates, and GDP, along with tax receipts, have grown over the past 50 years and look at how we got here. So, in this first chart, I've shown this before, but this is a percentage chart that shows the percent change since the start of the chart. And I picked the gold standard in 1971. I think it's a huge turning point in fiscal and monetary policy for the US. And what we can see is the gross federal debt has grown at 9,340%. Interest in blue has grown at 5,840%. And GDP has grown at 2,540%. So again, I keep using this analogy. I know it's not perfect, but it's pretty close. If you are an everyday American that works for a living, imagine the white line is your credit card balance, the blue line is the interest rate on that credit card, and the red line is your income. With debt, the nominal debt level does not really matter. What matters is two things: the ability to service that debt, which is GDP. GDP is the gross domestic product, the overall economic activity that serves as the potential that you can service the debt from. Or, if you're an individual, your income. So the ability to service the debt is what matters. And then the rate of change or the path, it also matters. Jerome Powell, the chairman of the Federal Reserve, has echoed that exact sentiment many times recently, where he says the level of the debt doesn't matter. The problem is not that we're at almost $37 trillion in debt. The problem is the path and the rate of change. And I would add another problem, which is the ability to service the debt. And so what we can see is the debt has grown, three times, four times faster than GDP, which is the economic activity that you can use to service the debt. And interest has grown twice as fast as GDP. So the cost of the debt is increasing much more rapidly than the actual economic activity is increasing. So there's two main components with how we kind of got here. For if you're the government, you have two main buckets. Just like an individual, you have your income, your revenue, and then you also have on the other hand, in the other bucket, you have your spending. And so in this slide, we'll look at revenue, and this is called tax receipts. Because that is the vast majority of where the government gets its revenue from is taxing that GDP that we were just talking about. Taxing the economic activity in their economy is how the government creates revenue. And so what we can see here in white is just the nominal receipts, the nominal revenue for the US government. And currently it's about 5 trillion. It's a little over 5 trillion. This data is lagged by a month or two. It's actually slightly higher. But we can see, that white line looks great. But again, it's not the nominal number with any of these things that matters. It is the share and the relative nature of some of these metrics. So here in red, we have tax receipts as a share of GDP. What we can see is that, going back to the 40s and 50s, it has basically bounced between 15% and 19% has basically been in this range. And because there was kind of this choppy volatility with the red line, I decided to kind of smooth it out with a moving average. So this yellow line shows the 9-month moving average for tax receipts as a share of GDP. And what we can see is that as a share of GDP, the government has been taxing, about the same amount of GDP. Because remember, if you are growing debt at $1 trillion a year, but you're growing your GDP at $2 trillion a year, well, that's actually a great return. This is equivalent to, if you want to go to school to learn a trade, you want to go be a doctor. You have to go $100,000, $200,000 in debt, but that once you have that medical license, once you have that degree, you will be able to generate, I don't know, $300,000 a year, and you will be able to service that debt no problem. It's really not too dissimilar for the government. Um, when it comes to this concept. And what the yellow line shows us is that as a share of that overall economic activity, they have been taxing a relatively constant amount. Currently, it's about 17% of GDP. So, put another way, tax receipts of 5 trillion. That's about 17% of U.S. GDP. And so I think it's important to point out that this has remained relatively constant. And in fact, it's increased from 2010 when it was down at kind of the high 15%. It has been generally trending up, meaning the government is collecting more revenue relative to GDP. They are swallowing up kind of a greater share of that overall economic activity in a marginal way, but I think a notable way. So the other side is government spending. And this is what we see in red. Red is again the nominal amount. And we can see it's close to $7 trillion. Again, some of this data is lagged by a quarter or a couple months, but generally speaking, this I think paints the picture quite well. Which is, government spending has been on a similar exponential path upwards. But again, it's not the nominal level of government spending that matters. Now, don't get me wrong, $7 trillion is a lot of money for the government to be spending every year. For sure, $1 trillion is such a kind of incomprehensible sum of money that it is hard to wrap your mind around, let alone 7 trillion. But again, what really matters is the share of GDP. And so that's what we see here in white. And what we can see is, currently we're about 23% of GDP. Government spending represents about 23% of GDP. Now, this is federal spending. Once you start to include local governments, city, municipal governments, and state governments, this number is over 30%. There's been a huge boom in state and local spending. Maybe topic for another video, but here we're looking just at the federal government, just at the U.S. federal government, and we can see that going back to the late 40s, clearly there this line only goes back to the 1947, but we were spending a lot of money relative to GDP during World War II, and then afterwards that fell off a cliff. But kind of in that post-war era, starting in the late 40s, we can see that this has trended up. So remember, tax receipts as a share of GDP have been basically flat. Um, Government spending, on the other hand, has been increasing. And again, remember with these relative lines, what this indicates is government, when the white line is going up, that means that government spending is growing faster than GDP. So here are kind of the two main buckets on one chart. And this is, federal outlays, the percent change since 1971, and then tax receipts percent change since 1971. And we can see the government spending since 1971 has grown at 3,350%. Uh, Tax receipts have only grown at 2,200%. And so you can see kind of this divergence where tax receipts start to kind of lag behind. Sure, they're growing, but you can see this delta start to kind of the gap between spending and revenue. You can see that kind of widening over time, over the past 10, 15 years or so. You can see that, and this delta, this gap between revenue and spending is one of the main things. I mean, essentially the main thing that is driving the deficit. The deficit now is 7% of GDP. This might not mean much, but this has never been seen before. Outside, with full employment, by the Fed's definition, we have a solid economy with full employment, and there's no, we're not fighting a world war. There's no domestic military conflict or anything really crazy going on, but yet 7%, the budget deficit is 7% of GDP. This has never been seen in peacetime with full employment. And this started many years ago, of course, but the trend has continued. In fiscal year 25, the deficit is actually higher than fiscal year 24 deficit. In fact, the deficit has grown by 11% from fiscal year 24 to fiscal year 25. So another really important concept, I think, is when we talk about the debt, is the productivity of the debt. And these are two of my favorite charts that I try to show as much as I can. Here we're looking at GDP divided by the total federal debt in white, and in red, GDP divided by the M2 money supply. And again, remember, when the numerator is growing faster than the denominator, this white line will go up. So during this period of time from the 50s all the way through the 70s, um, GDP was growing faster than the debt. This is good. This is exactly what you want to see in a healthy, productive economy. You want to see your overall economy growing faster than you're growing your debt. But what do we see starting in the early 80s? We see this just start to fall off a cliff and been trending down ever since. So what this means is that GDP has not been growing. The debt has been growing faster than GDP. So to maybe illustrate it a little bit better, I'll invert it. So we'll look at the debt divided by the GDP. And this shows you that it's the same chart, but hopefully easier concept or way to look at it. Here, the federal debt is growing faster than GDP, so this white line is going up. And what this means is that, we are issuing more and more debt, trying to get a return on it, and getting less and less and less. This is called the marginal productivity of debt. There's been a lot of research and academics and work done on this particular topic. And some academics have found that basically two things. One, your return on each dollar of debt goes down as your debt to GDP goes up. So at 80%, you might get a one-to-one return, but at 100%, you're getting less than a one-to-one return. And then it gets even worse the more the debt to GDP climbs. In addition, government spending as a share of GDP, there's another interesting paper that was done by, I think it was two Swedish economists, that showed that as government spending as a share of GDP, as this rises, um, you also lose 0.1% of GDP. I think it's for every 1% that the government spending as a share of GDP, this white line, for every 1% this white line goes up, you lose 0.1% in terms of your GDP, or from your potential GDP, from your trend rate, or your potential GDP. And so both of these are dragging on the US economy. We know government spending as a share of GDP has been climbing. This is a problem. This is resulting in lower GDP. And remember, GDP is what we use to service the debt. And not only that, but our debt to GDP has been increasing, is now over 120%. And so as that climbs, the return that we're getting for each dollar of debt is going down. So we're issuing more and more debt and getting less and less return. And this is what that white line shows. And it's been happening since the early 80s. We can see that there are these brief periods of time, like in the late 90s, when GDP was growing faster than the debt. But in general, this line is just up and to the right. And in red, we see GDP divided by the M2 money supply, which is a very, very similar concept. But instead of talking about the debt, we're talking about monetary units, the money supply. And we can see that, from the 50s through the 60s, this was basically range bound. There were periods of time where GDP was growing faster than the money supply. This is good. This is real growth. But then it would reverse, right? And there was it was basically just range bound here for a few decades. And then in the 90s, we saw real growth, right? GDP was growing faster than the money supply, which is great. That's exactly what you want to see. But then what we see, starting in the late 90s, is that the GDP, the money supply has been growing faster than GDP. And so I'll do the same thing we did with the debt. Hopefully, this is an easier way to kind of think about it or visualize it. Here we look at M2 over GDP. And so what this shows is that M2 has been growing faster than GDP. Because M2 is the numerator here. And so what this indicates is we are printing our way trying to print our way to prosperity by issuing all this debt, right, seen in white, and printing all these monetary units, as we see in red, and getting less and less actual return. This is the kind of what you see in emerging market quote unquote debt death spirals, is they start issuing more and more debt, printing more and more money, trying to get real economic activity, right? Get increased GDP. And unfortunately get less and less GDP. And it only kind of feeds on itself and gets worse over time. So another important piece of this whole puzzle is interest. So here in white, we see interest outlays. This is the total amount of interest the US government is paying. And then in red, we see that interest as a share of GDP. And then in blue, we see that interest as a share of tax receipts. So again, remember the nominal amount of interest doesn't necessarily matter so much, just like the nominal level of the debt. What really matters is kind of the share that interest represents out of GDP and out of revenue. I think there's two important distinctions here. Remember, GDP is just the potential activity with which you can use to service debts, right? We don't tax 100% of GDP. And if we did, GDP would plummet. You're kind of limited going, and this is also an important concept too, I should point out. When it comes to the revenue side, there is a level that when you start increasing the taxation as a share of GDP, you can start getting into, and this is well kind of documented phenomenon, that you can't tax your way out of this, because if you just start jacking up taxes, your GDP is going to fall. And so you can actually get the opposite kind of response that you're trying to get. So the government has to be really careful about taxation as a share of GDP. They can't just go, oh, we're going to tax 100% of GDP or 80% of GDP, because GDP would plummet in that sort of environment. So I think that is really important to remember with this red line. This red line, is just the potential GDP. It's not the actual revenue. So the blue line shows interest as a share of actual revenue. And what we can see over here is that currently interest expense is about 25% of tax receipts. Currently is about 23% according to this data. So what that means is that of the $5 trillion, about $1 trillion is going to interest. And I think that this is important to draw a parallel to, think of, you're an average person and you have a credit card bill. Imagine 25% of your income, say you make $100K a year, $25,000 a year, you are paying just in interest. You are not even touching the principal on your credit cards. You are literally just paying the interest on your credit cards, and it's eating up 25 grand a year out of your $100,000 a year salary. This is certainly elevated, and this is one of my favorite metrics to watch. It's not discussed a lot, but I think that this is a really important metric, and would encourage people to keep an eye on this metric, because this shows the share out of actual government revenue. It's one thing to talk about GDP and the potential, but we just talked about, they're kind of limited by how much they can tax, because once you start jacking taxes up too much, GDP starts to fall, and you actually get the opposite of what you're trying to do. So it's a very touchy, dynamic sort of thing. And I think that's why the blue line matters much more. Interestingly, I came across this interview with, I think it was Peter Schiff, many years ago, and they were talking about emerging market debt crises in Africa. And they mentioned this blue line, this metric, interest as a share of government revenue. And interestingly, they used 20% as kind of the line in the sand to determine when a nation's debt is getting out of control. 20%. And I thought that was interesting at the time. And I went to the IMF and the World Bank and did some reading and found that that 20% threshold was pretty widely kind of discussed as a ballpark way to measure kind of when the debt starts to become a crisis. And so again, we are at 23%. And I think that this number will be really important to watch moving forward. But imagine that 25% of the taxes that you paid last year, 25%, a quarter of them went just to interest, not paying down any debt, not paying any principal on the debt, on the national debt, just the interest on the national debt. I think most Americans should be upset with that. That is not sustainable. Here we're looking at just kind of the short term, very short term reaction to this news. Came out right after market close, and we can see that bond yields spiked. Here's the 5-year, 10-year, 20-year, and 30-year. 30-year rose about 6 basis points and then reversed all of it. The 20-year rose about I think 5 basis points and then reversed all of it. So it's all of these are trading right back where they were before the news hit. But I think the bond market will be something to keep an eye on. And I want to touch on a couple elements of the bond market just to finish up here. So here in the upper chart is what's called the real yield. And this is you take the 10-year yield, and you subtract the 10-year break even, inflation break even. And what that indicates is the premium above inflation that investors are requiring to buy a 10-year bond. And what we can see is that since 2021, this real yield went from being negative, right? Meaning anytime this is negative, this means inflation is higher than the bond yield. This is called financial repression. And this is when people talk about inflating the debt away, this is what they're talking about. They're talking about negative real yields, negative real rates. And this is how governments historically have dealt with debt crises is they run inflation and the kind of overall GDP, nominal GDP, higher than the interest rate on the debt. And by doing this, it decreases your debt load. You deleverage the country's balance sheet by doing this, by running negative real rates. But that point aside, what we can see is that the real yield has been rising sharply over the past 4 years as we have decided to run these kind of utterly insane 7% of GDP deficits and interest expenses is kind of skyrocketing and right all these issues with the debt over the past 3-4 years. um, Investors are requiring a higher premium in addition to inflation. And that is what this upper chart shows. And then in red here, we see a spread. So this is the 30-year bond minus the 2-year bond. And this is one of many spreads, but this kind of gives you an indication of the difference between the 30-year yield and the 2-year yield. And what I wanted to point out was that typically this is called a steepening when this red line is going up. What that means is the 30-year yield is higher than the 2-year yield and rising faster than the 2-year yield, or the 2-year yield is falling faster than the 30. That results in a steepening of the yield curve. Well, what we can see over here is that the real yield, generally speaking, outside of this little kind of short-term volatility here in late 2008, generally speaking, from 2007 all the way through to kind of the depths of the great financial crisis, the real yield fell and it actually went negative first in 2011. But in general, the direction of travel here on the real yield was down as the yield curve was steepening. And so there's two ways a yield curve can steepen. There's a bull steepener and a bear steepener. A bull steepener is what we saw then, which is this is when the shorter term bonds, called the 2-year in this example, all bond yields are falling, but the 2-year bond yield is falling faster than the 30-year. This is called a bull steepener. People are out buying bonds, right? People are buying all the bonds, but they are really buying the 2-year bond. And this is why it's called a bull steepener, is because it's bullish for bonds, because people are buying bonds. There's also another side, which is a bear steepener. And also, of course, here this phenomenon happened again, starting in 2018. The yield curve started to steepen, and the real yield was falling and ended up going negative. But that was happening as the yield curve was steepening. This was another bull steepener. So there is a distinction here, though, where we kind of currently find ourselves, which is we are in a bear steepener. What that means is that all bond yields are rising. The value of all bonds is going down. People are selling all the bonds, but they are especially selling the 30-year bond and the 20-year bond and the 10-year bond. This is a bear steepener because it is bearish for the value of the bonds, right? And what this means is that all interest rates are rising, but the longer term interest rates are rising faster than the shorter term interest rates. This is called a bear steepener. And what we see is this distinction, right? This is different from what we see here in 2018 when the real yield was falling. The premium over inflation that was being demanded was actually declining as the yield curve was steepening. This is because it was a bull steepener. And the same thing with 2008, or heading into 2008, where the real yield fell from, call it, what is that, positive 2.8 all the way down to negative, basically negative 1%. Uh, and that was occurring as the yield curve was steepening, but it was a bull steepener. And so what we notice here is the exact opposite, which is the premium is going up. The real yield is actually going up as the yield curve is also steepening. And so this is uh, generally speaking unusual. And so I thought it was important to kind of point out. Here we see in white the 30-year minus the 2-year, and then in red I put the S&P 500 to illustrate another point, kind of along those lines, which is generally speaking, like here, let's look at the dot-com bubble and the dot-com recession. So we can see that in red here, the S&P. I'll put it here just in case we're forgetting. So here in red, we see the top of the S&P 500 in red. And what we can see is it perfectly marked the flatness, the tights of this particular yield curve spread. And as the dot-com bubble popped, and kind of the recession that followed, we can see the yield curve steepened. And this is the 30-year minus the 2-year, but it's a very, it's essentially the identical concept we were just talking about. This was a bull steepener where everyone was buying bonds, but they were really buying the 1-year and the 2-year, the shorter term bonds. And the reason a bull steepener usually happens is in anticipation of a Federal Reserve interest rate cut. When the Fed cuts rates, the 2-year yield is mainly kind of dependent, or mainly the main what the 2-year yield is really indicating is the path of the Federal Reserve. The shorter term interest rates, they don't move around very much. And when they do, they're only moving around because it's anticipating or trying to telegraph what the Fed is going to do with the overnight rate. That is not the case with the longer term bonds, which move much more independently on things like inflation and growth and fiscal concerns. And so this is why that spread can give you a lot of information. And so what we see is, the yield curve steepened here as the dot-com bubble was popping and the recession and the economy was contracting. And the reason for that was a bull steepener. People were rushing out and buying the short-term bonds because, if I can lock in 3% on a 2-year bond, I can lock in 3% for 2 years, and I know the Federal Reserve is going to take rates down to 1%. So, that's a good deal. So you rush out and you buy that short-term bond. And that means the short-term bond rate falls faster than the longer term. bond yields are falling. This is the bull steepener, and this is in anticipation of Federal Reserve rate cuts in the face of economic weakness, which is what this sell off in the S&P indicated, and the kind of contraction in the economy. We saw that again in 2008 here, where the S&P made its top here, and the yield curve was right around kind of the flat, and as the S&P sold off, the yield curve steepened. And again, this was a bull steepener because this was in anticipation. The economy was contracting, growth was slowing. Everyone knew the Fed needed to cut interest rates. So what do people do? They buy the short-term bonds first and kind of the heaviest, meaning short-term rates fall faster than the longer-term rates fall. Because remember, the bond yield is inverse to the value of the bond. Um, that is not what we're seeing here. We are seeing the yield curve steepen in the face of a rising S&P 500 growth, which looks okay, right? Unemployment is not skyrocketing yet. So I think it's important because this indicates a bear steepener indicates a much different thing than a bull steepener, which is what we see here, what we just kind of went over in 2000, the .com in 2008. A bear steepener, which is what we see here, indicates much different things, which is much more concerns around the debt, right? A bear steepener is where all bond yields are rising. So all the bond yields in general kind of are rising. It's just that the longer term bonds, call it the 30-year in this example, the 30-year is rising faster. Now remember, the bond yield is inverse to the value of the bond. So what that means is the value of the longer term bonds is falling faster than the value of the short term bonds. As rates have gone up, all the values have gone down. But the 20, the 10, 20, and 30-year values of those bonds, the value of those bonds has declined much more rapidly. And so that's a bear steepener. And that's what we've kind of generally speaking been seeing, which is, all rates have been kind of moving higher, but the longer term rates are really moving higher. And we point this out all the time since Liberation Day. What we've really seen, generally speaking, since post Liberation Day, is a bear steepener, which is, the 2 years kind of marginally higher, 2 years slightly higher than it was. But the 10 and especially the 30 are much higher. The yields are much higher than they were before Liberation Day. And so again, this indicates much different things than a bull steepener, like we were talking about, in anticipation of Federal Reserve rate cuts. This indicates much more, concerns about the debt. We mentioned financial repression, negative real rates. This is how governments have always dealt with these debt issues. If the bond market is looking at the debt and deficit, right, 7% of GDP deficit, 23% of receipts are going to interest, right? They're looking at all the same things. They are realizing the debt is becoming more of an issue. They are going to, the risk for inflation, if you're buying a 30-year bond or a 20-year bond or a 10-year bond, is so much higher for you. So that is why the longer term rates are rising faster than the shorter term rates. Again, if you're worried about 10% inflation due to the debt, right, and due to all the things we've just talked about, you're not going to be super worried about the interest rate on a 1-year bond. If you are locking yourselves into a 30-year contract, basically, with the US government, you are going to be much more sensitive to inflation, right? Just because you have to think, 10, 20, 30 years out in the future, not just what's right in front of you. You have to plan for, because think about it. If you buy a 30-year bond today at 4.9%, and 5 years from now, inflation is 10 or 15, you are losing significant amounts of money. And so again, the kind of these fiscal concerns and financial repression and inflating the debt away and long-term inflation expectations are much more reflected in the 30-year, the 20-year, the 10-year. You look at, the 1 year or the 2 year, and that basically is just trying to predict where the Federal Reserve is going to go. But these longer term rates indicate the concern with kind of fiscal issues, long term inflation expectations, right? That's when these things start getting kind of coming into play, is the longer term bonds. And so that's why these bear steepeners, I think, are noteworthy to at least point out here. So hopefully that was helpful. I know I couldn't touch on everything, but try to hit the major points. Hopefully that was helpful. And I'll talk to you guys later.